A retired teacher from regional Victoria paid over $2,800 in tax that she didn't legally owe. But under the correct application of 5 separate provisions in Australian tax law, her tax bill should have been close to zero. Every year, thousands of Australian retirees are doing the same thing, paying tax they do not legally owe. Not because they've made a mistake on their tax return, and not because the ATO has changed the rules, because nobody ever told them the rules existed in the first place. The remarkable part is that none of these 5 provisions require a complicated trust structure. They don't need a self-managed super fund or a 6-figure investment portfolio. They're available to ordinary Australians over 60. The tax office knows these provisions exist. Your super fund knows they exist. Most accountants know they exist. Yet millions of retirees have never heard of them. And here's why this matters right now. The first 2 become available the moment you turn 60. The next 3 unlock at 67. One of them can increase the amount of income you receive before paying tax by more than $13,000 per year. Another can put cash directly back into your bank account even if you owe no tax at all. And the final one can save retirees thousands of dollars every year on prescriptions, healthcare costs, utility bills, and council rates. If you're retired, semi-retired, drawing from super, or approaching pension age, there's a very good chance at least one of these applies to you, possibly several. Before we continue, I should tell you I'm not a financial planner, a solicitor, or a licensed advisor. This video is general information only. For your situation, please speak with a solicitor in your state or a registered financial planner. The tax system is extremely good at collecting money people owe. It's far less effective at telling people when they're entitled to keep more of it. Today, I'm going to walk you through 5 provisions specifically designed for Australian retirees. They're legal, they're available right now, and if you've never checked whether they apply to you, there's a reasonable chance you've been leaving money on the table for years. Let's start with the one that surprises people the most, because once you understand this first rule, almost everything else in retirement starts to make more sense. Tax break number 1. Tax-free super pension income. The moment you turn 60 and begin drawing income from a taxed superannuation fund, that income generally becomes tax-free. Not low tax, not partially exempt, tax-free. For many Australians, this comes as a genuine shock. They spent their entire working lives assuming income equals tax, salary equals tax, interest equals tax, investment income equals tax. Then suddenly, they retire. They discover that their super pension operates under a completely different set of rules. The payments you receive from an account-based pension generally aren't taxed in your hands. The ATO doesn't take a share. There is no marginal tax rate applied. The money simply arrives in your account. But that's only half the story. Something else happens at exactly the same time. Inside the fund itself, earnings may also become tax-free. While money remains in accumulation phase, investment earnings are generally taxed at 15%. Move that money into retirement phase, and that tax can disappear. That's a significant difference over time. The people who miss this aren't usually inexperienced investors. It's often the opposite. They're financially responsible people who assume everything happens automatically. David from Brisbane retired with around $680,000 sitting inside an industry super fund. He knew he'd turned 60. He knew he was retired. He'd even heard someone say super becomes tax-free after 60. What he didn't know was that his money was still sitting in accumulation phase. Nobody explained the distinction. Nobody called him. Nobody sent a warning. Meanwhile, the fund continued paying tax on earnings that potentially didn't need to be taxed at all. The money wasn't disappearing dramatically. It was leaking away quietly. That's how most retirement mistakes happen. Not through bad decisions, through missing information. If you're over 60 and drawing income from super, one simple question is worth asking your fund. Is my balance currently in accumulation phase or retirement phase? That single question can change the entire conversation. Now, If you thought that was surprising, the next one is even more overlooked. Because it involves money, the ATO may actually pay back to you. Tax break number 2. Refundable franking credits. Most retirees know Australian shares pay dividends. What many don't know is that those dividends can come with something incredibly valuable attached: franking credits. When an Australian company earns profit, it pays company tax before distributing dividends to shareholders. That tax has already been paid. The franking credit represents that payment. For most working Australians, franking credits simply reduce the tax they owe. Nothing unusual. But retirement changes the equation, because if your tax liability is low or zero, excess franking credits don't disappear. The ATO refunds them in cash. Imagine you own a portfolio of Australian shares generating $3,000 worth of fully franked dividends. Those dividends may come with over $1,200 worth of franking credits attached. If your tax bill is already zero because you're drawing tax-free super income, those credits may be refunded directly to you. That's real money. Money many retirees never claim. And the reason is surprisingly simple. Nobody explained how the system works. Many retirees assume the company already paid the tax, so the benefit ends there. It doesn't. Australia's dividend imputation system was specifically designed to avoid double taxation. And for retirees with low tax liabilities, it can become a significant source of additional income. Now let's move to the tax break I saw missed more than any other during my years working in the system, because this one alone can completely change a retiree's tax position. Tax break number 3, SAPTO. It stands for the Seniors and Pensioners Tax Offset. The name sounds boring, the impact isn't. This offset directly reduces the amount of tax you owe, dollar for dollar. Not a deduction, not an adjustment, a direct reduction. For eligible Australians, it can effectively increase the amount of income you can receive before paying tax by more than $13,000 compared with a standard taxpayer. Think about that for a moment. 2 Australians earning similar amounts of income. One pays tax, the other pays little or none. Not because they're wealthier, not because they're using clever strategies, because one qualifies for SAPTO. The most common misunderstanding is that people think you need to receive the age pension. You don't. That's the mistake. Many self-funded retirees automatically assume they don't qualify. They've never received Centrelink payments. They've never applied for the pension. They assume SAPTO doesn't apply. Often, they're wrong. Norma is 70 years old. She lives alone. Her annual income sits around $31,000. Every year she paid tax because she assumed that was simply how the system worked. When her situation was reviewed properly, SAPTO reduced her tax liability to almost nothing. Not because anything changed. The law had always worked that way. She just hadn't been told. If you're over 67 and earning less than roughly $50,000 a year, one question is worth asking immediately. Have I been assessed correctly for SAPTO? Because the answer may be worth thousands of dollars. And if SAPTO has been missed, there's a good chance the next tax break has been missed as well. Tax break number 4, Medicare levy relief. Most Australians know they pay a Medicare levy. What fewer people realise is that retirees eligible for SAPTO often receive significantly more generous Medicare levy thresholds. In practical terms, that means some retirees shouldn't be paying the levy at all, yet many do. Why? Because if SAPTO wasn't properly considered, the Medicare calculations often end up wrong as well. The two issues frequently travel together. It's one of the reasons reviewing your overall tax position is so important. A retiree might focus on the tax bill itself while overlooking the Medicare levy sitting right beside it. Both matter, both add up, and both can potentially be reduced under the rules already in place, which brings us to the 5th and final benefit. And in terms of real-world value, this may be the biggest one of all, because unlike the others, it doesn't just reduce tax, it reduces the cost of everyday life. Tax break number 5, the Commonwealth Seniors Health Card. If you're over 67 and not receiving the age pension, this is the entitlement you need to know about. Because millions of Australians assume they don't qualify, many are wrong. The Commonwealth Seniors Health Card was specifically designed for retirees who sit in the middle. Too much income for the pension, not enough income to comfortably absorb every healthcare cost. The benefit package can be substantial. Cheaper PBS prescriptions, lower Medicare safety net thresholds, state-based concessions, energy discounts, council rate discounts, transport concessions. The exact value depends on where you live and your circumstances, but for many retirees, the savings run into the thousands every year. Here's the part most people miss. There is no assets test. None. You can own your home, you can have substantial super, you can hold investments. The assessment focuses primarily on income. Jessica was 72 when she finally discovered this. She owned her home, had over $1 million in super, and automatically assumed she was too wealthy to qualify. She never checked. For years she paid full prescription costs and missed concessions she was legally entitled to receive. When she finally looked into it, she discovered she qualified all along. The card had been there, the savings had been there, the information hadn't. And that's really the story behind all 5 of these provisions. None are secret. Every one of them sits openly in legislation. The problem isn't access. The problem is awareness. Most Australians aren't told about them. The people who benefit are usually the people who ask questions, the people who check, the people who take an hour to understand how the rules apply to their situation. So here's where I'd start. Pull out your most recent tax return. Check whether SAPTO has been applied. Review your Medicare levy calculation. Confirm whether your super is sitting in accumulation phase or retirement phase. If you own Australian shares, find out whether you're receiving the full value of your franking credits. And if you're over 67 and not receiving the age pension, spend 10 minutes checking your eligibility for the Commonwealth Seniors Health Card. One conversation could save you thousands. One question could uncover something you've missed for years. Because the biggest gap in retirement outcomes isn't usually investment performance. It isn't market timing, and it isn't luck. It's information. The law already provides these opportunities. The challenge is making sure the people who need them actually hear about them. That's the purpose of this channel. Thanks for watching, and take care.